Hey guys, Brian Davis here from Spark Rental. Super excited to be with you today. And I am very excited to be joined by Tom Dunkel of the Belrose Storage Group. Tom, thank you so much for joining us.
Hey, Brian, it's great to be with you today. Thanks for having me.
Yeah, so we were actually supposed to sit down last week, but we had some technical challenges, which is what happens when you when you broadcast these sorts of
Exactly.
things
Yeah,
live. Uh,
right.
so Tom is an expert in self storage investing, in syndications, in alternative assets, and alternative types of real estate investments. So without further ado, Tom, let's jump in and rewind to the beginning of your real estate story. Tell us how you got started in real estate investing and in alternative assets in particular.
Sure, Brian. Yeah, thanks again for having me. It's kind of a dangerous question because number one, I'm getting a little old, and number two, I tend to be long-winded. But I'll try to keep it punchy. So I was a corporate finance and mergers and acquisitions guy in corporate America for about 10, 12 years until 2006, when I actually got fired from my job with a publicly traded company, which actually ended up being exactly what I needed to have happen to me to really get me out and start me on my entrepreneurial career, which I had wanted to be doing anyway. But sometimes it's hard to make that leap, and when you get kind of kicked in the rear and you have to pick yourself up and dust yourself off, sometimes that's what it takes. But
I've been there.
so that was 2006. You've been there. Yeah. So that was 2006. I had always wanted to get into real estate. Of course, that was probably the worst time to start in real estate. However, even though I pretty much lost all the money that I'd set aside to start my own company, I did learn a ton, and I was able to uh, reinvent myself and connect with the right people and partners and get the right experience and the right education after the crash. Because of course, I had a great career in corporate life, and when I went into my entrepreneurial life, I was like, oh, well, this is going to be easy, right? I've got an MBA from a great school. I've got this great experience with top professionals in their industries, and so I figured it was going to be easy peasy. Well, I learned the hard way that it wasn't. Um, so anyway, so I started out like a lot of folks do, doing residential real estate, wholesaling, rentals, fix and flips, that kind of thing. But when the market crashed and I needed to reinvent, I pretty much got out of all those businesses, and I started buying pools of distressed residential mortgages. And that business, I was in kind of the right place at the right time. I connected with a great partner, Joe Downs. We're still partners today, 12 years later. And that business really kind of took off over the years. We raised a bunch of money from high net worth individuals, and that helped to fuel our growth. And to this point, in that business we've done over $50 million of revenue,
Oh wow.
and yeah, which has allowed us over the years to start doing some other things. So we started doing some hard money lending, which didn't quite work out for us, but we learned from those experiences as well. And we got into um, a short-term vacation rental portfolio. So that's still running, and that's been great, especially in the COVID era.
Yeah.
But our primary business right now is self storage. So we started buying self storage facilities really early 2020. Closed on our first one in kind of mid 2020. And like we do with all of our businesses, whether it's the rentals or the distressed mortgage debt, we put our own money out there first so we can learn the business, make the mistakes, correct the mistakes, and figure out what works, what doesn't, and get the right team together and make sure we're executing at a high level. And so once we kind of perfect those things, then we go out to our friends and family, et cetera, and that's when we start doing our syndications. So that's what we're doing today, Brian. Is we're doing self storage syndications, meaning that we're pulling groups of investors together. and we're buying these self-storage facilities primarily in the Eastern U.S.
Okay. All right. Well, there's so much to break down there. And it's funny that you mentioned some of the twists and turns along the way. We before we went live here, we were talking about how in most people's businesses, there are all these unexpected twists and turns, and that what you end up specializing in is not necessarily what you set out to thinking that your business is going to be. So, I can certainly relate with all of that. So tell us a little bit about self-storage investing, the fundamentals of that business, the typical returns that you see, some of the risks that you see, because, most residential real estate investors are not super familiar with self-storage as a real estate niche.
Sure. Great question. So yes, self-storage has always sort of been a little bit of a redheaded stepchild in the commercial real estate space, but kind of under the radar, it's also been one of the best performing, or arguably the best performing commercial asset class out there for the past really 30 plus years. What we love about self-storage is like all real estate, right? It's connected to a hard asset. So unlike the internet days and the .com bubble burst, you actually have a hard asset that you're investing in. By the way, I feel like we're sort of revisiting that whole time period with crypto right now. But anyway, we'll save that for NFTs, another podcast.
Yeah.
Yeah. Because I'm not sure what people are investing in there other than, these ideas and it reminds me, like I said, I was in investment banking in the internet bubble era, and it was, I never understood what those guys were talking about. But anyway, self-storage, I can get my head around, right? Because it's metal boxes with concrete floors and roll-up doors. It's not a super complex industry. That's another thing that we like about it is people like to invest in things that they know and understand, so when it's a hard asset and it's pretty easy business model that's cash flowing, and we can get great terms on our debt. We're typically getting 75% loan to value loans. And of course, rates have been going up recently, but our rental rates have been going up faster. So
sure. Inflation helps on that front.
Yeah, it absolutely does. And people should be concerned about inflation. I mean, it's obviously eating away at buying power in a lot of different areas of our lives. But one of the things I do like is our rental rates across our portfolio were up 22% last year. So we're way ahead of inflation in that regard. The only question for the future is, how much are interest rates going to go up, and how much pressure is that going to put on property values coming down? So that remains to be seen. I'm certainly not a fortune teller. I don't think anybody is. But I like where we are. We have a great operations team, so that's really what we're focusing on right now. For example, the delinquency rate in most self-storage facilities around the country is about 10%. Across our portfolio, we're at about 3%. And that reason is because we really focus in on our management key performance indicators, and that's a big one. And so we just make sure that we keep that low and make sure we keep the rental rates high. And that keeps the cash flowing for our investors.
Yeah. So, you mentioned not having a crystal ball as far as, what's going to happen to property values, but with income investments like self-storage facilities, property values dipping a little bit doesn't necessarily have to impact you as long as the cash flow continues to perform. So can you tell us about your typical returns on these facilities that you've seen so far? Now, I understand you've only been in this space for a few years, but what do you typically look for, and what do you want to see as far as returns among self-storage facilities?
Yes, and you did ask me that earlier. Like I said, I kind of start going off and I lost track of what the question.
It's a casual conversation around here.
I know, exactly. But thank you for bringing that back up, because, of course, returns is the name of the game, right? And that's what investors are looking for. That's what I look for when I'm looking at other investments as well. And so when we're underwriting our deals, we as the sponsors have a split of the deal, and our and our investors have a split of the deal on a passive basis. And so when we're doing our underwriting and our projections, we're trying to gear that so that our investors are making a high teens IRR, internal rate of return. And because people do like cash flow generally, we also pay a preferred return, typically in the 6, 8, 10% range. And those payments are made quarterly. And because sometimes people they just want to see that income coming in.
Sure.
And so to this point, we've been exceeding those projections for our investors, which we'd love to continue doing that. But like we talked about a second ago, crystal balls are difficult. But we're very conservative with our underwriting, and that's really from my training, in my corporate life, doing the mergers and acquisitions and doing the corporate finance for these big public companies. That was what I did. I built the models that projected out the financial performance. And so I learned a long time ago that you really want to under promise and over deliver. So that's really part of the core values and culture of our company is we under promise, and that gives us the ability to over deliver. And sometimes when you're first doing it, it's hard to under promise because you want everyone to think how great you are, and you want to give them this great
you're going to raise the money
sales
for the
pitch
deal,
with these hockey stick returns and such. But again, over the years, we've done it over and over and over again, and in all of our businesses, we underperform, we under promise, we over deliver, and and the beautiful thing about that, Brian, is our investors, they stick with us. Our repeat investor rate is through the roof, and our investors, they start out investing a little bit of money, and then they increase that over time, and they bring their friends and they bring their family. So we know we're doing something right because we're able to generate those returns and get those kinds of referrals from our investors, which is great. We really appreciate that.
Yeah, and that is key to longevity in any business is the repeat business, the word of mouth. So we've danced a little bit around this topic of where the market is headed, potential for recession. So I hear repeated time and time again that, self-storage facilities, they're one of the few recession-proof investments. We should all be pouring our money into self-storage facilities. So tell us either why that's true, why it's completely false, or why it's partially true, but not as clear-cut as the internet makes it out to be.
Sure, of course. There's truth and maybe some caution to be thrown in there as well. But we have in our investor deck, in our investor pitch deck, we have a slide that shows over the past 30 years, it shows the GDP, right? So the growth, GDP growth, and of course it's a crazy looking graph because of course we have boom cycles, we have bust cycles, booms and busts, and everything in between. And then over top of that, we have occupancy for self-storage facilities going back to the 80s. And that line goes about like this. So meaning that whether the economy is booming, if it's crashing, if it's somewhere in between, people always have been needing a place to store their stuff outside of their house. And so that's why occupancy rates in self-storage have generally been between 80 and 90% on average across the country for that entire time period. So when people say it's a great, recession-proof kind of asset class, I do definitely have to agree for the most part. But where folks can get in trouble is, and this is, again, something I've learned because I've been through some booms and busts. When things were crashing in 08, 09, and 2010, a lot of folks were over levered, right? And so they had too much debt on their properties, and the cash flow dwindled, and they couldn't make their payments, and they lose the property, and the equity gets wiped out, right? Nobody wants that. And having lived through that and learned from that experience, we definitely take great measures in making sure that we can certainly cover our debt payments. But unfortunately, there are folks out there today who are continuing to pay very high prices for facilities, and I'm concerned that those folks are going to end up in a bad place in another 1-2 years as this recession starts to rear its ugly head. And I certainly don't wish that on anybody, but we're seeing it happen out there where folks are taking on a lot more debt than they should. So that's certainly a risk in any kind of asset class where leverage is being used.
Right.
But that's definitely something that we take a very cautious look at because that's not, again, we want to under promise and over deliver. We can't do that if we're pushing on the leverage.
So now I understand that Belrose Storage Group only allows accredited investors, wealthier investors, to participate. But a lot of our audience members are not accredited investors. Do you have any tips for non-accredited investors who want to put some of their money in self-storage? How they might go about doing that?
Sure. Yeah. So while we certainly do look primarily for accredited investors, we do have the opportunity to include non-accredited investors on some of our capital raises. But in order to do that, we really need to have a pre-existing relationship with those folks. And reason being, we need to have a comfort level that this person is going to understand the investment. And they are going to be okay if things go really badly and they lose their money. We need to know that it's not going to be the end of the world for them.
Right.
And so we need to have that comfort level both ways before a non-accredited investor would be permitted into one of our opportunities. As far as how other folks approach it, I'm not really sure. But if certainly a non-accredited person might still be able to go and get a loan and find a self-storage facility on their own, because there really are all shapes and sizes of self-storage facilities out there, just like other commercial asset classes. I have a friend of mine that he bought it was like a 50-unit facility for a few $100,000. So if you're not accredited, maybe that's where you start, and hopefully things, you run the facility well and you grow your wealth, and then you can become an accredited investor, which opens the door to a lot of other opportunities. But you got to start somewhere. So I would encourage people to just, if you're not accredited, make it a goal to become accredited, and just start putting those pieces in place and getting educated and getting the right team together so that you can reach that goal.
Yeah, absolutely. And, if you are interested in investing directly in a self-storage facility, but you don't have any experience, you can always partner with someone else who does have some experience. You can, cut down the cash required for you to participate, get exposed to some expertise in the process.
Absolutely.
So with Belrose Storage Group, what is the minimum investment for people to participate in your syndications?
So our minimum investment stated in our documents is $25,000, but there's a little asterisk there because the myself and my partners, we have the ability to flex that number if we need to. I know some folks, maybe they're invested in other things, but they could come in at a lower amount if we had a chat about it beforehand. But yeah, we're typically looking for $25,000. Because our typical raise is in about $1 million range. So, it'd be tough for us administratively if we, just took on a lot of smaller investors, but
sure.
But we're also in the relationship business, right? So if someone came to us and said, hey, 25,000 doesn't work for me right now for whatever reason, can I, kind of test drive you guys at, 10,000 or 15,000? If we had a chat about that and you got comfortable with us and we got comfortable with you, of course we would entertain that, of course.
All right. Well, so I've put a link here in the comments to belrosestorategroup.com where people can learn more about what you are up to and the investments you guys are making, signing up with you guys. Is there anything else that you want to leave the audience with before we wrap up this conversation about self-storage investing and syndications?
Sure, absolutely. Actually, it's broader than that, if I may, Brian. But
please, yeah.
As I've kind of alluded to during our chat today, I've been around for a little bit. I've had some great experiences. I've also had some great learning experiences where I've gotten my butt kicked pretty good. So what I've done is I've actually compiled some of the lessons that I've learned and put them into an ebook, which is available on our website, www.belrosestoragegroup.com. And you don't have to give your email or your name or your phone number, any of that stuff. It's available for anyone that wants to go grab it on our homepage. And what it is it's a resource for folks to do their due diligence. So it's called Safe Investing. Reduce your risk and achieve your investment goals. And so what it is, it's a framework for people who are interested in alternative investments, whether it's real estate or lending or whatever else. It gives a list, it gives a framework. So it gives a list of questions in an organized format. And SAFE, as you might have seen, is an acronym, SAFE. S is sponsor. So who's the sponsor? Who's running the deal? What's their background? What's their track record? Are they criminals?
Right.
Are they wanted?
Yeah.
So, so it gives a list of questions to ask about the sponsor. And the ultimate question, Brian, is, can I sleep well at night knowing that this person has my hard-earned money?
Right.
And then it goes on to A, which is for asset. What is the asset I'm investing in? If they do a deal with us, they're investing in membership interests in an LLC that owns a self-storage facility. And so it gives a list of questions about, what is the asset? F is for financials, and all the questions about what are the financial aspects of this deal? What are the projections? Are they believable? Has the sponsor delivered these kinds of projections in the past? And what kind of returns can I expect? And then E is exit. How do I get out of this thing? Because it's not like you can go to schwab.com and click and get your money out. It's in a syndication deals like ours, your money is going to be tied up for 2, 3, 4, 5 years. And so you need to know that going in, and you need to also know what are those circumstances that have to come about for me to get my money back? And do I have any control over that? And how does that happen? When does that happen? Those kinds of things. So the whole point of all these questions is to just help people with a framework to do their due diligence, because due diligence is very, very important. And what are the questions you should ask? And ultimately, it's, can I sleep well at night, knowing the sponsor, knowing the asset, knowing the financials, knowing the exit strategy for this deal? So I encourage everyone to come to the website and pick that up.
It's a fantastic resource. Thank you so much for sharing that with us. And that's very generous to be giving away ebooks without requiring email addresses or names or any of the stuff that most people require for when they give out.
Just trying to add value. Just trying to add value, Brian.
Well, Tom, thank you again for joining us today. This was a fantastic conversation, very eye-opening about self-storage facilities, alternative assets, and syndications as well. And we hope to have you back here soon.
I'd love to be with you again, Brian. Thanks so much.
All right. Have a great week. See you guys next week. Bye now.